Hello everyone, I'm Devendra Negi. I'm a founder of BFSI Courses Academy. It's an online learning portal for courses related to NISM, banking, insurances, and others. So today we are going to discuss the mock questions related to NISM equity derivative certification exams. It will help you to enhance your knowledge, and it will give you some idea how you can practice this sample questions. This question is also available on our website, so you can head over to our website www.bfsicourses.com and enroll yourself for an online mock questions where you will get an unlimited access to the free mock test. There is no any limit to take the test. Unlimited tests can be taken, unlimited number of attempts, and it's a lifetime validity. So let's get started today's session. The first question is, if the liquid assets maintained by clearing members Mr. Ram are higher than that of Mr. Shyam, which of the below options is or are true? There is no need to maintain liquid assets. Both Mr. Ram and Shyam have the same level of exposure. Mr. Ram has higher level of exposure than Mr. Shyam. Mr. Shyam has higher higher exposure level than Mr. Shyam's. So as you see that in this questions, Mr. Ram has maintained the higher liquid assets. So he has higher liquid asset than Shyam. So of course, he will be getting more exposure based on the liquid assets which he has put, as he is a clearing member, which is abbreviation of CM, and this clearing member will get higher exposure level. So the answer will be C. This is an explanation. You can also check this out. The PDF, we have a PDF of this mock question, 100 MCQs, which you can download, and you can also read the explanation. The explanation is simple as per the exchange and SEBI regulations. So all the gross positions at any point of time in future and options, it shall not exceed a particular percentage of the liquid net worth of a clearing member or a member. So Mr. Ram keeps higher liquid assets as a security and margin with the exchange. He will get higher exposure limits. Operational risk includes losses due to. So you need to understand what is operational risk. So there are different risks faced by the market participants, and one of the risks is operational risk. So inadequate disaster planning, too much of management control, income tax regulation, government policies. So these second last and last option, it is not an operational risk, is a regulatory or a sovereign risk. So here is inadequate disaster planning. Too much of management control is not an operational risk, it's a company or a management risk. So the first option is the right one. So operational risk arises from a failed internal processes, people, system, or any external events. Like disaster planning is an example of if you do not have a proper disaster planning, then it will have an operational risk. Operational risk includes fraud, system failures, and any human error. Margin and futures trading are to be paid by. So who pays the margins? Only the buyer, only the seller, or both buyer and seller, or the clearing corporation? I think the last is not correct. There may be confusion in the first three. Last is not correct because clearing corporation takes the margin amount in order to settle the trades done by the buyer and seller. So in case of futures, both the party has an obligation. So both has to pay the margins. So the third one is the right answer. So this is an explanation. Margin are the deposits that trader must keep, ensure that they will be able to fulfill their obligations in the futures contract. So both the buyer and seller must pay the margins, and it is set by the exchange how much margin is to be paid, and the initial margin or the mark-to-market margin, the peak margin. So that margin is to be collected by the clearing member or the clearing corporation. And put option gives the buyer a right to sell how much of the underlying to the writer of an options. So the buyer is buying an option. So how much underlying? How much is the underlying? Any quantity? The answer is no. Only the specified quantity or the lot size of the contract, or the specified quantity or less than the specified quantity, or a specified quantity or more than the specified quantity. The answer is third one, because the lot size of the option contract, that anyone who wants to buy, suppose one lot, it's 50. So one lot has a 50 size. So in case of Nifty 50 option, it may be, it's a put option, is put European, or it may be a call European. So only the lot size. So not only the specified quantity which is set by the exchange. Fifth question, fixed deposits and bank guarantees are not permitted to be offered by clearing members to the clearing corporation as a part of liquid assets. So clearing member has to put liquid assets to the clearing corporations. So is the statement as true or false? So I've written it down, the false statement first and true statement second, because most of the time in the examination, when you encounter these kind of questions, false comes at the first one, and generally we find the true and false if this statement is false, right? We generally see the second option is the answer, right? And we ticked it in the examination, our answer gets wrong. Here you need to put it the first one. The first one is the right, there is the false, because the member they are permitted, they are allowed to give the fixed deposits and the bank guarantees. Okay. 3 call series of XYZ stock January, February and March are quoted, which will have the lowest option premium, the same strikes. So which one will have a lower premium? January, February, March, or all will be equal as they have the same strike price? No, there will be a time value which will be considered based on the maturity. The day of the maturity of the contract will have. So January will have a lowest maturity date, it will have a highest, so the premium of the same strike price will be low in the month of January. In case of foreign portfolio investors, which is called FPI, the gains or losses arising from the derivative transactions on a recognized stock exchange are taxable as. Is a very, very important questions. So derivative is a short-term contract. So they are not considered as an speculative gains, income from other sources, not long-term, because derivative is less than 1 year contract. So all the gains is considered as a short-term capital gain. Short-term capital gain for foreign portfolio investors. In case of Indian investors, the income is considered as a business income for Indian investor. They are talking about the foreign portfolio investors. Mark-to-market margins are collected. So mark-to-market margin is also MTM or M2M margins. Mark-to-market means you are valuing your positions on a daily basis. So it is understood that on a daily basis, this is are collected. This is being collected, not on a weekly basis, not every 2 days, or not every 3 days, on a daily basis. Initial margins collection is monitored by. So margins in the stock exchange, all the trade happens in case of future and options. The clearing corporation comes into picture, who gives a guarantee of the settlement of the trade, and that process is called novation. So this term is being used in the securities operation risk management. So you must know this term related to the clearing corporation. So they become a counterparty for both buyer and seller. So initial margin is collected by the clearing corporation. The main objective of the trade guarantee fund at the exchange is to guarantee settlement of bona fide transactions of the members of the exchange, to inculcate confidence in the minds of market participants, to protect the interests of investors in securities, all of the above. The answer is all of the above, because this fund gives the settlement of the genuine transactions done by the members in the exchange. So it also inculcates confidence on the minds of the market participants that the trade is will be settled no matter what happened by the other party, to protect the interest of the investors. Who is eligible for clearing trades in index options? All Indian citizens, all members of the stock exchange, all national level distributors, only members who are registered with the derivative segments as clearing members. So it is an easy questions that clearing members help the settlement of the trade, and they must be registered with the derivative segments, and they will help in clearing the trades in case of futures and options. Which of the following measures was introduced by SEBI to prevent brokers from allowing excessive intraday leverage to their clients? So brokers, the trading members, they provide the leverage or the margin trading facility to their clients, right? So how much exposure that they can give to their clients based on the peak margin. So a span margin is calculated for the initial margins. Exposure margin is for the any initial margins plus extra margin which has been taken. A cross margin is based on the if you have an exposure in the cash market and the derivative market. So here for intraday leverage, in order to check that, the peak margin is to be checked. Profit from derivative transactions for Indian investors are taxed at. In the previous questions where we have discussed the foreign portfolio investors, where the income has been taxed as a short-term capital gain. In case of Indian investors, how they are going to be taxed? Is it for the short-term capital gain tax as with the foreign portfolio investors, or with another, or is it a speculative income? Is it the first one is speculative income under head profit and gain of the business or profession, short-term capital gain under the head of capital gains, non-speculative income under the head income from other sources, or non-speculative income under the head profit and gains of the business or profession? Which one is the right one? The answer is option D. So important questions. If the lot size of Reliance Industry futures contract is 500 share, so in one lot you are getting 500 shares. The lots, what will be the lot size of the option contract? So whenever there is a future contract which has a lot size of 500, the same will goes to the options also. Option will have the same lot size. The 500 is the right answer. When compared to cash market, there are more chances than that the investor does not properly understand the risk involved in the derivative market. True or false? Of course, derivative market is more complicated. Is because it is used for the risk management, it is used for the speculative trade, it is used for the arbitrage. So not an investor is able to understand, is difficult to understand than the cash market. When it compared with the cash market, then of course the level of difficulty is higher. So the answer is true. When you buy a put option on a stock, you are owning. So whenever you own a stock and you buy a put option, what strategy is called? It's called a straddle, writing a cover call, calendar spread, or a protective put. So do you know what straddle mean? Or when you sell a covered call and selling a covered call, do you know what is calendar spread? And protective put. So protective put means whenever you buy a put option, you have an anticipation that if the price of the stock that you own goes down, you will have a loss. So in order to protect the loss, then this strategy is called protective put. It is like when you own a vehicle and you buy an insurance, that if something happens to your vehicle, you pay a premium for that. In the same way, you buy a put option, you pay a premium, and if the price goes down, it's unfavorable for you, then you exercise the put option and you will downsize your risk. The intrinsic value is the difference between market price and strike price of an option and can never be negative. So intrinsic value of call option and put option. So intrinsic value is always be positive, and it is only in case of in the money options for both, either call or put. So the answer is it cannot be negative. It's the difference between the market price and the strike price. So if the market price, so you have a strike price, suppose 2000 is a strike price. Okay, and the current market price is 2200 is a call option. So in case of call option, this is the current market price. The difference between is 200. This is called an intrinsic value. The answer is true. A trader sells a lower strike price call option and buys a higher strike price call option. Both of the same script, same stock, and same expiry date. This strategy is called. So this is a spread strategy. So you need to understand whether it is a bullish spread or a bearish spread. So butterfly will have 4 positions. It has a 4 positions where there will be a 3 legs. So there will be different leg. So in case of bullish spread, so what you do, you buy lower strike price, low, and sell higher strike price. In case of bullish spread, in case of bearish spread, you sell lower strike price, you buy higher strike price. So that is called bearish spread. So here the trader is selling a lower strike price and buying a higher strike price. So this strategy is called the bearish spread. So in examination, the question maybe come for the bullish spread as well, and also for the butterfly long-term investment. Actually, future and options are not for investment purposes. It's only for risk management purposes and some kind of speculations. So for investment purposes, we buy stocks, mutual funds, bonds, real estate, commodities, right? When the near leg of a calendar spread transactions on the index future expires, the farther leg becomes a regular open positions. So suppose it means you have a calendar spread where you have buy current month option. You buy current month futures, index futures, and you sell next month futures. So you buy how many? So buy 10, sell 7. So it means when this future expires, the current month, the further becomes an regular open positions. Regular open positions. Okay. The answer is true. So the settlement is done either physical or cash. The type of volatility which is derived from the option pricing and indicates the volatility expected over the life of the options is termed as. So volatility that we expect in the future, in case of options. So one volatility which can be derived from the previous data is called the historical volatility, where we calculate the standard deviation based on the daily changes in the price of the stock, right? So implied volatility means whatever is the price of option premium is and the time to expire the contract, we know we can get the anticipation of the volatility during the life. So there may be 10 days the option contract is going to expire, and in 10 days whatever the premium that is going to be, then we can calculate the implied volatility, which is denoted with IV in short form. So this question may be asked in short form as well in the exam. At the price volatility of the underlying stock of the put option. Higher would be the premium, lower would be the premium. Zero volatility does not affect put value. As we know that there are different option Greeks, and one of the options Greek is related to the volatility, right? Vega. So whenever there is a higher volatility, price volatility of the underlying stock price, it will have an impact on the options premium also. So the premium higher would be the premium, because the price can go in any direction of that stock. European call options gives a buyer the right but not the obligation to buy from a seller and underlying at the prevailing market price on or before the expiry date. False or true? On or before. So this is the major thing, on or before. So European call options or put option, right? They expire on, not before. So this statement is false. So it on or before is American option. American options. Got it? So European options cannot be exercised before the expiry date. This is important. In Indian stock exchange, we follow the European options. That's why you find CE, PE. PE stands for the European. Call European, put European. If it may be denoted CA, PA, then it is call American, put American. Trader A wants to sell 20 contracts of August series at 4,500 and Trader B wants to sell 17 contracts of September series at 4,550. Lot size is 50 for both these contracts. Okay, initial margin is fixed at 6%. How much initial margin is required to be collected from both these investors? So there are two investors, A and B. They wants to sell 20 contract. He wants to sell 17 contract. The lot size is 50. Lot size is 50. The price, strike price is 4,500. Is 4,550. You multiply this with the percentage, 6% into 6%. So you'll get the value of both these and you get the answer. So here the first trader will be paying 2,70,000. The second one is paying 2,32,050. Add both margins and it will be an initial margin in order to get the trade. You sold one XYZ stock futures contract 278. So you short, this can be asked as a short as well. You short one XYZ stock future. So you short one call at 278. So you sold it at 278. The lot size is 1,200. If you purchase the contract at 265, so it means you will have a profit. You're selling at a higher price, buying at a lower price. So the difference between both these and multiply by 1,200 will be your profit. Easy one. If the price of futures contract decreases, the margin account of the buyer of this futures contract is debited for the loss. So whenever the futures contract is decreases, so you have bought a contract, you are a buyer, you have a long position or a long position. You have a long position in the contract. It means that whenever there is a decrease in the price, the underlying, then you have to pay the amount, the loss, right? And this loss will be debited from your margin account. The statement is true. So that's it. There are 25 questions